Hey, what's up guys? In this video, I'm going to show you how you can start investing in the UK in 2026. Now I know you're probably asking, look, 2026 has already started. I know, I tried to get the video out earlier and well, I haven't really got around to it. I'm doing it now, so here we go. Right, so first thing you want to do when you want to start investing is you want to find a broker. Now, there are two types of brokers. There are the ones that offer commission free and there are the ones that don't offer commission free, right? Obviously, you'll want to go with the one that offers either low or zero commission. Now, some examples of these are Trading212, IG Group, or InvestEngine. Now, you'll obviously have to pick and choose which one is your favorite, but as I said, they all offer commission-free investing, and there's lots more out there that do that as well. The second thing you want to do is you want to make sure you open an ISA, because when you open an ISA, you pay zero tax, no tax on there, right? You get a £20,000 limit. That's the most you can deposit, right? That doesn't factor in if it's gone up. It's just deposits. Most people won't do that. Obviously, you know how much money you're making. You know if you know you'll be able to do that. But 20,000 is a lot, and it's actually one of the best things about the UK in terms of the financial benefits we have. The ISA is, you know, it trumps a lot of other countries. It's very good. So you want to make sure you're using that. Obviously, you don't have to use up the maximum 20,000. Most people don't, but you want to make sure you're putting in some every year, and it will help your financial future. In terms of the ISAs, they do contribute to different. They all combine, if that makes sense. So if you've got a cash ISA with 5,000 in, you've got a stocks and shares ISA with 5,000 in, your allowance is 10,000 now on the stocks and shares ISA. Right, so they all combine. I know now the cash ISA is the allowance is lower. I'm not exactly sure what it is. I know it's lower. Just be aware of that, because obviously you don't want to go over the limit. So I think the cash ISA is 15,000 now. Maybe it's a little bit lower. I don't know. Stocks and shares ISA is 20,000. But if I obviously I can't. You know, I mean, me personally, I don't open a cash ISA because I think you can get better. I believe I can get better returns in a stocks and shares ISA. That's just my own prerogative. You are, of course, you can do whatever you like. Now, the other account you can open is a general investment account. Now, this is an account where you can get taxed on. Now, you'd only open this account if you are getting beyond the 20,000 limit, right? If you're depositing more than 20,000 a year, tax year, then yeah, it may be advisable to start putting it in a general investment account. That said, there are other investment options as well. If you really don't want to pay tax, like premium bonds, you can even, you know, buy actual commodities. They've been doing very well recently. You know, you can buy a house, whatever. I mean, there's lots of options for you to do. In terms of the general investment account and taxes, I'm not going to go into that. As I said, that one can get taxed. Tax on capital gains, dividends, all that stuff. So as I said, keep it in the ISA. It's simple, it's not taxed, everything is good. Now, the big question, what to invest in? Now, many people, and even some of the professional investors like Warren Buffett, they will advocate for a low-cost index fund ETF that tracks the S&P 500. So some of the examples of this are the VU or the VUSA, which are Vanguard provided funds. You also have the SPDR or SPDR. I don't know who does that one, but it tracks the S&P, right? And if you don't know what the S&P 500 is, it is the top 500 largest companies in the United States of America. And pretty much you're just buying a small portion of each company, right? And it's good if you want, you know, long-term growth, and it's relatively safe. I mean, yeah, you will have downturns. That's inevitable. But I mean, in terms of investing into individual stocks, obviously that will be a lot more riskier, but potentially higher reward, right? So again, this is for all you to do up your research. I probably shouldn't say if it's safe or if it isn't safe. As I said, you need to do your own research on that. But investing in an index fund is a good choice. You know, no one will talk down on that. That's There's nothing wrong with that. And if you look at it, the S&P over the past 5 years, it's done very good returns. It's beaten many companies, and you know the statistics show that over the long term, the S&P beats many people trying to beat the market. Some people will say, "Oh, should you invest in the global?" which is like all the companies. So you got the Asian market, European, etc., etc. Or should you invest in the American? I would always say invest in the S&P. Why? Because the S&P already makes up a large chunk of the global market. Therefore, I believe if you're investing into the global market, you're essentially diluting your investment, therefore making it less returns. Now, I would say yes, there'll be less downside when you get a market crash or something, but at the end of the day, you should be investing long term. So I believe that the pros outweigh the cons. But again, that's just my personal opinion. You are free to do whatever you want. But as I said, if I had the choice between global, which is all the like 2,000 of the top companies across the world, or 500 just in America, I would choose the ones just in America. The American market and the American economy is very related to the global economy. Yeah, I've got my notes here. Over the past 5 years, the S&P has achieved an incredible 87 return. So, speaks for itself. Obviously, yeah, if you look at 2008 and the 2008 and the 2000s, you'll see a significant depletion of value because, as I said, market downturns are inevitable for one reason or another. There will be times where, people are very bearish and stocks go down. That's another term. If you don't know, bullish is when people think that the stocks go up. Bearish is when they think it goes down. It was coined with how the animals attack. But yeah, that if you hear people saying it, that's what it means. Yeah, as I said, index funds I would say less risky than individual shares because you obviously have more money in different shares, whereas an individual stock, you just have your money in that share. Obviously, you can invest into different shares and whatever, but not always. You can have ETFs that are, on one sector that's very volatile. So again, it depends. But just for the S&P, I would think that it'd be less risky than an individual stock. But again, it does depend on the individual stock. If you've got a utility stock, then that's likely to not have as much downturn as a tech stock per se, right? Also, there is a method that a lot of investors use called dollar cost averaging, which pretty much means where you'll put pretty much the same amount of money, the same week or the same day or same month, regardless of price. You won't really look at the price. You just do it pretty much as a direct debit, and then it's done. And what it does is it averages out. So sometimes you may buy a high price, sometimes you may buy at a low price. Doesn't matter. Regardless, the price goes up, and you make money. And if the price goes down, that's fine. You may buy it when it's at the highest point. When it's going down, you might buy it at the lowest point. The whole point is you're supposed to average out and get a positive return in the future, because that's what investing is ultimately. And as I said, you look at the S&P, it's gone up 87% in the past 5 years. So people are incredibly bullish, and as it removes trying to time the market and any sort of kind of trying to get the perfect price or any of that sort of stuff. You buy it, and that's that. You wait till the next month and then you buy it again. Pretty much that's the video. I don't know if I've missed some stuff out. This is my first video. I'm kind of doing it kind of doing it with no script. Kind of just got some notes, and that's that. As I said, none of this is financial advice. Your capital is always at risk when investing. Thank you guys for watching, and I'll see you in the next one. If you have any questions, I'll try my best to answer them. As I said, I'm not a financial advisor. But yeah, I'll see you guys in the next video, and thank you guys for watching. Bye.